SwayamPrabha. Digital India. Educated India.
Greetings to all of you. I am Dr. Raju Maji, Assistant Professor, Faculty of Law, Banaras Hindu University. Dear students, I welcome you all in this lecture series on the subject Law of Banking and Negotiable Instruments. So, before I start my lecture, I would like to tell you that why this subject is very important. As in the present time we will see that any development of economic or you can see the wealth of any nations, we cannot imagine without the help of banking sector. So, in that way we can say the banking sector plays a very significant role as far as concerned the economic development, the economic stability, economic strength, and overall that we can say that in our body, like the blood circulation is very important for running our body. In the similarly for running the economic systems of any country, the banking sector plays like a lifeline of any economic systems of any country. So, with this background, I would like to again one thing which I like to mention before I start this lecture, that the banking sector of any country is one of the important tools which we can say that with the help of that instrument we can strengthen the economic systems of any country. So, the banking plays a very significant role as far as the economic development of any country. So, with this background we will have to see that in the first lecture I will tell you about that the evolution of banking system and the development, and as well as I will discuss about the development of banking laws particularly in our country. If we will see that when the systems which I have adopted to discuss in this lecture, I will discuss with you the evolution of banking in the world, how this world emerged, and the second I will discuss about the development of banking, and the third heads I will discuss with you the evolution of banking and banking system in India, and finally we will see that the development of banking laws in our country. With these four heads we will discuss. As far as concerned that when we are talking about the words bank, the word bank, there are three kinds of beliefs and we will have to see on their observations how they have established that the banking. If you will see the first, some of the authorities believe that the word bank has been derived from the Greek word banquo, B-A-N-Q-U-E, which means a bench. Their argument on the basis of it, they said that in the olden days the Jews entered into money transactions sitting on benches in a marketplace. When a banker was not in a position to meet his obligations, the bench on which he used to sit and carry on money business, it was broken into pieces and was taken as bankrupt. So, thus both the words bank and bankrupt are said to have their origin from the word banquo. So, in this way we can see that the very interesting, the another observations which has been made, some of the authors believe that their belief is that they believe the word bank is originally derived from the German word Beck, B-A-C-K, meaning a joint stock fund. Their belief is that the Germans occupied Italy, the word was Italicized. The word Beck became Banco and finally it became bank under the English. But that is not the end. As my concern, there are some other authorities, the economists, they believe that the word bank is derived from the Italian word banco, B-A-N-C-O, which means a bench. It was upon the bench in the marketplace that the early bankers, whilst the medieval European moneylenders and the money changers used to display their coins and transact business. So, in that way, if you will see that the word which has been from the Italy or from the Germany, it appears that at that time some of the, you can say, the persons, they were engaged in the money transaction business, and they were displayed their coins and the other things in the market, and they are normally using to display their coins in the market, and they use the bench, and that might be the one of the reason bank and the bankrupt, when they are not in a position to discharge their obligations, they broken their benches on which they displayed their coins and the other things for the transactions, and that the words we got the bankrupt. So, from that bankrupt we have the bankruptcy word. So, in that way we can say in the olden days that the words in what way that is emerged, that is a different issue, but as far as concerned the authority, they believe that it is emerged in that way. Now, the evolutions of banking when we are talking about, then we will have to see the very back, and we will find that some of the authoritative books, particularly the Tennant's, he described the certain things as far as concerned the early history of banking. According to him, as early as 2000 BC, the Babylonians had developed a system of banks, and at the same time the Greek temples were used as depositories for the people's surplus fund, and these were the centers of money lending transactions. So, at that in the olden days, there were no any kinds of, you can say, the depositories, or there were no any kind of the faith amongst any individual. That might be the reason that the temples were used for the purpose of depositories of the money, the surplus money which the public having at that time. And it is evident from the 2000 BC, when the Babylonians, they have developed their banking systems, and as I have told you that the Greek temples were used as depositories for the people's surplus fund, and these were the centers of money lending transactions at that time. Now, it is very important to mention here that with the arrival of civilizations in the middle of the 12th century, the first bank was found at Venice in 1157. That was the first evidences which we found through the writings of the scholars, and they have mentioned in the first time that in a systematized way we can say in the 12th century that the world community got the first bank, and that was found at Venice in 1157. And the later on, with that development, another banks were established at Barcelona in the same year, the 1157, and Genoa in 1407. Now, the origin of when we are talking about the origin of the modern banking, that may be traced to the moneylenders in the Florence and received money on deposits and were lenders of money in the 14th century. So, gradually up to 12th century we are getting that the modern banking can be traced to the money dealers in Florence and received money on deposit and were lenders of money in the 14th century. And the later on, it is very important to mention here that the one statement which I made by the Adam Smith in his an inquiry into the nature and causes of the wealth of nations, he observed, and it is very important to quote here. I would like to quote, the earliest banks of Italy where the name began were finance companies to make loans and float loans for the government of the cities in which they were formed. After these banks had long been established, they began to do what we call as banking business, but at first they never thought of it. From these observations, he also you can say that mentioning, and he is supporting that the word which we have taken that from the Italian word, and he is mentioned that the banks were from we have taken that word, and it proves that the banking sector origins from the Italy. But later on we evidence that in England during the reign of Edward III, money changing functions of bankers was taken up by Royal Exchanger for the benefit of the crown and to exchange the various foreign coins. It was found at the time of the Edward III in England that the first time we got that the money changing functions of bankers was taken up by the Royal Exchanger, and they were work for the benefit of the crown and to exchange the various foreign coins also. The later on, in the development of the business of banking can mainly be attributed to the London goldsmiths during the reign of Queen Elizabeth I. At that time, the goldsmiths, they were engaged in the money transactions, they were engaged to give the loans, and particularly they were helping the government's treasury at that time. It was continued, but there were some sort of the problems. Due to that, the goldsmiths business were stopped, and later on we find, but it was the great contributions made by the goldsmith that the Bank of England was established in the year 1694. It is the evidence from the scholars' writings that the Bank of England first time it was established in 1694. There were joint stock companies doing banking business, and they were flourishing in England. These companies had introduced deposit banking and check currency and many other services which a bank can offer. In the present time, if you see that the works the bankers who are rendering to their customers, it was probably that was start with the beginning of the joint stock companies, where the joint stock companies involve themselves in the banking business, and particularly it is evidence from the England, where after the establishment of the Bank of England in the year 1694, that the joint stock companies started working in the England, and not only they started working in England, but they were flourished in a very tremendous way. And these companies, due to their popularity, their growth in that time, so they started to render all sorts of the banking services, particularly when we are talking about the check, currency, and many other services which a bank can offer. The later on in 1826, an act was passed in England which allowed to banks to be started with unlimited liability, consisting of more than 6 partners with the right to issue note, provided that they had no office within the radius of 56 miles from London. Thus, a new joint stock banks were started. Note issue power were given to the Bank of England by the Act of 1708. As we have seen that the Bank of England was established in the year 1694, and I have told you that it was started working as a joint stock company, and their growth were continued, and that might be the reason that in the year 1826 an act was passed in the England which allowed to banks to be started with the unlimited liability. So, there are the liabilities earlier, joint stock company, they have the limited liability, but the later on by passing that act they started the unlimited liability. But the conditions were laid down at the end. That what are the conditions? The first condition is that it must be consisting of more than 6 partners. That means the minimum 6 partners is required to run that joint stock company, and that joint stock company will start it with the limited liability. And that bank which they had at the time, which were started by the 6 partners, they had given a right to issue note, provided they had no office within the radius of 56 miles from the London. Means any bank which is away from the 56 kilometers from the London, they have given that right to issue the notes at that time. Thus, in that way we find that in England the new joint stock banks were started, and that with the unlimited liability, and as the same time we have find that these banks were, if they are established themselves or situated away from the 56 kilometer from the London, they have a right to issue the notes, and the bank of, with the help of that, to empower these banks, the Bank of England Act was passed in the year 1708. However, one thing which I like to mention here, that the full development of modern commercial banking in England to await the passage of the Act of 1833, which permitted the formations of joint stock banks. It was only in the 19th century that the modern banking system with joint stock banks developed in the leading world countries. Now, we can understand that what are the problems, because at the beginning, as I have told you, that where the bank were run by an individual. Some of the, you can say the goldsmith, or you can say some of the persons those who were involved in the money transactions at that time. But as my concern that there were no concept of the joint stock company. It was introduced in the England, and we find that the requirement. But as my concern, when we are talking about the other parts of the world that were help, or they have learned from the act which was passed in the England in 1833, which permitted the formation of joint stock banks. And due to that, or it consequently, or you can say the resulting that in the 19th century, that the modern banking system with joint stock banks developed in the leading world countries. In that way, we can say that although the bank word were evolved from the Italy, or it was taken from the Germany word, but as my concern that for the development of the banking business in the world, it was contributed, or in the many way we can say that the contributions had been made by the England by taking such kind of steps for the build-up of the banking system, and permitted from the very with the help of only the minimum 6 persons as a partnership, they can start the joint stock companies. And then we got that it was promoted by the government at the time by passing the certain act which empowers the power to the such joint stock companies banks to issue the bank notes, subject to if they are establish themselves away from the London, that is the distance were made that 56 miles. And that was one of the, we can say, the steps or you can say the development of the modern banking systems that begins in the 19th century, that the modern banking systems of the with joint stock banks developed in the leading world countries. Now, with these backgrounds, just I would like to come the situations in our country. As far as the country that we are believing that in most of the scholars, or you can say that most of the scripts which we have at that time, the banking systems were existed either way. I am not saying that the fully you can say the developed banking system, but as my concern that when we are talking about what are the functions of the banking is to accept deposits, and the second one is to lend the money. In that way, if we will discuss about the evolutions of banking in India, then we will have to go back again, and we will have to take some of the texts which were existed at the time on all those taxes. It is evidence that in either way the banking systems were prevailing in India also. The banking was existence in India during the Vedic times from 2000 BC to 1400 BC. It is evidence from that. The loans and usury were well understood in those days. Money lending was regarded as an old art. The rishis occasionally lamented their state of indebtedness. If we will see that in our even in the Vedic times that the rin word was there, and that was even not accepted in the well manner. It was, if the rin, that means the person has taken money from someone else, and under the Vedic period, it was very important that the money which you have taken, that has to be returned. The obligations had been made towards the people. Again, in the later on, if you will see, it was found in the Aryan days also. The money lending was practiced in the early Aryan days. During those days, money lending was considered as one of the 4 honest callings, the other 3 being, that is tillage, trading and harvesting. Rin, that means debt, is often mentioned from the Rig Veda onwards, reflecting a normal conditions prevalent in the Vedic society. In that way, we can understand that even in the Vedic period, even the later on, even in the olden days of the Aryan age, it was found that in some way the banking systems were existed. That might be the reason that in all the texts we find the rin word, which means the someone brought money from some other persons, and it was considered that whenever they have taken money, it is their pious obligation to return that. The latter part when we will see, and it is I like to mention before you that there are references of lending and banking two epics, namely Mahabharata and Ramayana, which are concerned with the events of life which took place between 1000 and 700 BC. During that period, banking has become full-fledged business. At that time, for the treasury, for the development of, or you can say, the helping the kings for their kingdom, that there were some kind of, you can say that the treasury people, they were helping the king by giving some sort of, you can say, the loans and other things. So we also find that in both the epics, Mahabharata or the Ramayana, it was mentioned that during that period the banking business were working as a full-fledged way. Even latter part, if we will see, during the Sutra period from the 7th to 2nd century BC are available from the Buddhist writings called the Jatakas. The Jatakas clearly establish the existence of money lenders called Seths who perform the functions of a banker. So in the latter part when we will see, then in India we find that it is evidence from the writings of the Buddhist writings and the Jatakas, they were involved. The Jatakas clearly established the existence of money lenders, and the money lendings work were performed by the persons, and they were called the Seths at the time. Even today, if you will see, sometime if you go in the rural area, then you will find the Seths. And even in some of the Hindi films, if you recall, then you find the Seth, they were working as a money lenders. So it is evidence from the Buddhist writing also that during that period the money lenders were existed and they were called as a Seths. From the Buddha and the Mahavira, they denounced the practice of money lending. According to them, money lending was a sin and created huge agonies to the mankind. However, in the Buddhist period, even the Brahmins and Kshatriyas started taking banking as a business. In this period, the bills of exchange also came into use. Now, it is a very interesting thing, as I have told you, that in only that every kind of, you can say, the text of if you will take from the Vedic period, the Aryan period, and the later on when we are coming to the Buddhist period, then in every times that the money lending business was not considered as the good one. Even if you will see that the Buddha and Mahavira, they denounced the practice of money lending. And as far as concerned their understanding, they said that the money lending was a sin and created huge agonies to mankind. That might be the reason that when the people, those who are the followers of the Buddhas or the Mahavir, they left that business, and that might be the reasons that to take over that business, the Brahmins, even the Brahmins and the Kshatriyas, they were involved themselves, they were engaged themselves in the banking business. That might be the reason in this period we find that the bill of exchange. As far as concerned that when we are talking of the bill of exchange, the bill of exchange is a relation between the creditor and debtor, where the creditor, he is making an order towards the debtor to pay that money to the bearer of the instruments. We will discuss that when we will discuss the negotiable instruments, but as far as the time being now, because at the time it was introduced and the bill of exchange is an order. So the first time you understand, we find that the bill of exchange came into existence during that the period, and we find that it was the period when the Buddhas were there. In the latter part, we again find there is evidence the banking business was being carried in the Smriti period. The Smriti were compiled between 600 and 200 BC. Gautam, Brihaspati, Prasara, Yajnavalkya, etc. explained the methods of regulations of interest in their Smritis. So when we are talking about the Smriti period, even it is evidence that during that period the banking systems were mentioned by many of the Smritikas. If we will take the name of the Gautam, Brihaspati, Prasra, Yajnavalkya, they were very clearly mentioned in their text that the and explained the methods of regulations of interest in the Smriti. It is not only that, even we find in the laws of Manu, the Manu is regarded one of the great scholar as far as concerned that for the development of Hindu law, particularly when we will read and when we will see, then the laws of Manu bestowed wide powers on the creditors for the recovery of the debt. In short, this period is characterized as one in which the activities of the so-called bankers or money lenders were well controlled and regulated. It was the Manu during that periods that the king's treasury was taken on a very you can say importance, and that might be the reason that in his writings he characterized the all sorts of you can say the rules and regulations for the bankers or the moneylenders, how it can be controlled and how their act will be regulated. So, the credit goes to the Manu's writings at the time for the regulations and control of the activities of the moneylenders or the bankers, those who were existed at that time or those who were involved themselves in the banking business. In the later on we find that the Kautilya in his Arthashastra, which was written in the Maurya period in 4th century BC, mentioned the maximum rate of interest which could be charged by the lenders. The bankers during this period were known as Sahukars and Mahajans. The word which we are using even in the present time as Fankers and the money lenders. During the period of Mauryas, that the Kautilya, it is evidence for the Kautilya Arthashastra that he, you can say that he empowered, the money lenders were empowered, and what is that? They can charge the maximum interest rate and it is bound, and one of the reasons that might be one reason that to reduce the people's do not take the loans or from any the money lenders, but the whatever may be the reason that was, but that from this Kautilya Arthashastra it is evidence that the maximum rate of interest can be charged at that time by the money lenders. And very interestingly, these money lenders were designated as at that time as the Sahukars and Mahajans. Now, it is not the end, even we have experience during the Mughal period. During the Mughal period, the indigenous banking in its prime, there was hardly a village in India without its money lender or shrub who financed trade and commerce. The system of currency and coinage in operation at that time rendered money lending a highly profitable business. However, there was a great fall in the banking system during this period as the Muslims regarded taking of interest as a sin. That is very interesting. It is not only in the Hindus, even in the Muslim. That might be the reason that the money lenders who were existed at the time, and during the Mughal period, it is the Muslims, under the Muslims personal law, that the someone who is earning the money from in terms of the interest, that was regarded as one of the greatest you can say the sin, and that might be the reason that the banking systems were fall down at the time, because the believers of the Muslim religion, they withdrawn themselves from that business, and that might be the reason during that period that although it was considered that the money lending business is one of the most profitable business, but besides that the banking systems are fall down, and the reason might be that the message was given by the Muslim beliefs or the under the Muslim law that the taking of interest as a sin. Now, after that, if we will see that in India the Britishers came, the Britishers came in India, the advent of Britishers in India plays a very significant role for the development of modern banking system in India. So, we will see one by one some of the events, the important events, how that the modern banking system evolved or developed in our country. When the British came in the India in the 17th century, they found reasonably well established indigenous banking system. The East India Company came to India as trader, and it established its agency houses at Bombay, Calcutta, Madras in India. As when we are looking towards the Britishers when came into India, we know the Britishers were not came India for the purpose of rule the India. It is the times, the changing scenario, they have changed their opinion and they ruled India, but they were their main purpose was to came India at the time in the 17th century only for the purpose of trading, and they entered in India as a company, the East India Company, and the East India Company came to India as a trader, and it established its agency business at Bombay, Calcutta and Madras in India. By establishing that agency houses in the three cities, what we are calling in the present time that the metropolitan cities, the Calcutta, the Bombay and the Madras, with the establishment of that agency, they further established the Bank of Hindustan, a mere appendage of Alexander and Company, was the earliest bank set up under European directions in India in the year 1771 at Calcutta. It could not survive due to the failure of its parent firm and was ultimately collapsed in the year 1832. But if you will see that it works for the long period and see the nomenclature of the bank, it is very important to mention here that when they started to do the banking business in our country, so naturally the money to accept the deposits from the public, and the public were the Hindu or you can Muslim, and at that time that might be the reason that the Sindhu to Hindu, the Hindustan. So, very cleverly that the Alexander and Company, when he established a bank in the European directions in India in the year 1771 at Calcutta, see how beautifully they named that the Bank of Hindustan, so that he can create the image amongst the citizens of this country, or you can say the domicile of this country, they can believe and the very attractive name they have put, that is the Bank of Hindustan. But ultimately, as we have experienced that in the year 1832, due to the parent firm, it was collapse of and the reason behind it, the bank is also collapsed in the year 1832. Then the later on 1784, another landmark year where the Bengal Bank was established in the year 1784. The later on, the General Bank of India came into existence in the year 1786, was the first joint stock bank in India having limited appointed as bankers to the government. However, it did not survive for a long and was ultimately dissolved in the year 1791. If you will see that the first time the General Bank of India was started as the first joint stock bank in India with the limited appointed as a bankers to the government. However, as we have seen that in the year 1791 that bank was dissolved. The later on that they have experienced the new kind of you can say the things, and the some of the you can say the banks which were collapsed, which were established earlier, they learned, and that might be the reason they established three presidency banks, namely the Bank of Calcutta, Bank of Bombay and Bank of Madras were established in 1806, 1840 and 1843 respectively. So, if you will see that in three, because their agency were working in these three you can say the part of the country, in the three cities of the country, they were established the three presidency bank, because at that time these were called the presidency towns. So, that the regions that they established three presidency banks. One bank was established in the year 1806 in the name of the Bank of Calcutta, now it is called the Kolkata. Then 1840, the another presidency bank was established in the name of the Bank of Bombay. Now we are calling it the Mumbai. And the third bank which were established in the name of the Bank of Madras in the year 1843. And now we are calling that city as a Chennai. So these three presidency banks were established in the year 1806, Bank of Calcutta, 1840, the Bank of Bombay, and 1843, the Bank of Madras were established in those days because they were the presidency town. So the presidency banks were established in the three presidency towns. But the later on, in the year 1921, these presidency banks were amalgamated into the Imperial Bank of India, and that Imperial Bank of India came into existence in the year 1921, and that came into effect from the 27th January 1921. So the later on, with the development of the bank, that these three presidency bank which were established in the year 1806, 1840 and 1843, respectively in the presidency town of Calcutta, the Bombay and the Madras, these three presidency banks were amalgamated and there's new banks were formed, and the banks were called the Imperial Bank of India, and that Imperial Bank of India came into effect on the 27th January 1921. Apart from that, in the 1865, one of the very important bank was set up or established with the help of the European management, and that bank was the Allahabad Bank. The Allahabad Bank was established in the year 1865 and with the help of the European management. And the later on, again in the 1875, if we'll see, then we'll find the Alliance Bank of Simla was started. But at the first time in the year 1889, with the help of the Indian management, a joint bank was established in the name of Old Commercial Bank. And the first time that we have shifted from the European management to the Indian management, and the Indian management bank were established in the form of the joint bank, that is Old Commercial Bank, which came into existence in the year 1889, and that was followed by the establishment of the Punjab National Bank in 1894 and the People's Bank of India in 1901. That the later on, the very important you can say that the events which took place in our country, that the first time we use the Swadesi movement, the Swadesi word, and the Swadesi attract, that means it promotes our own the indigenous banking system. As we know that earlier we have seen that our indigenous banking systems were working very, you can say they played a significant role for the development of the banking systems in our country from the ancient days. So during that period, the 1905, the Swadesi movement was started, and due to that, the Swadesi movement, it was promoted the domestic banks, and the many banks were established by the Indians due to the Swadesi movement. That means the Indian people, they have started to deny to deposit their money, the banks which were established at the time by the European management, and they encourage their people to establish more and more banks, and that might be the reason that the period in India, the 1906 to 1930 was a period of boom for the Indian bank. We experienced that during that period, the large numbers of banks were established. Some of the events which I like to mention here, that the Bank of Burma was established in the year 1904, and in the 1906, there more banks were founded, namely the Bank of India, the Bank of Rangoon, and the Indian Spice Bank. Some of the other banks were established during this period, namely the Bank of India in 1906, the Bank of Baroda in 1908, and the Central Bank of India in 1911. As we are experiencing, these banks are still working. But at the same time, we will have to discuss certain things, that the period when we have discussed that the very important, that is 1906 to 1913, that as far as concerned that the India, that was the golden period for the development of banking system. But the very soon, as far as concerned that when we will see that the Indian banking system found or they undergone through the crisis, and some of the things which were found, and it is experienced that the India was facing the crisis as far as concerned the banking sector. Banking in India experienced severe setback during the period of 1913 to 17, as 101 banks failed and another 373 banks failed in 1922 to 1936, which was again followed the failure of 620 more banks in 1937 to 1948. Again I am repeating it, that India faces the huge crisis as far as concerned the banking sector faces and experienced the setback during the period of 1913 to 17, as we have seen that 108 banks failed and another 373 banks failed in 1922 to 1936, which was again followed the failure of 620 more banks in 1937 to 1948. But if you will see that 1906 to 1913, how many banks came into existence, but the later on these banks were undergone through the various crises and the banks failed to carry their business. One thing which I understand that might be the reason that the two world war took place. The world war in the 1914, the another world war in the 1936 onwards. So that might be the reason during that period we will see the Indian banks failed. The establishment, the very important event which we will have to see, and that is the establishment of the Reserve Bank of India in the year 1935 marked the beginning of a new era in the history of Indian banking. It is no doubt that with the help of the Young Hilton Commission's report, they recommended that there is a need of a central bank of this country. So, in the name of the Reserve Bank of India, the central bank was established. And subsequently, if you will see that in the efforts of the Reserve Bank of India were mainly directed towards institutionalized of savings, consolidation of banking structure and reorienting the credit systems to emerging needs of the economy. Then not only that, the later on we experienced that the cooperative bank started functioning in India in the year 1904 with the sole aim to finance agriculture sector. As we have seen that due to the Swadesi movement, we promoted to the cooperative banks, and the purpose was to establish the cooperative bank to finance the agriculture sector. As even today that we are experiencing, the cooperative banks are now working on the three-tier basis, namely the primary cooperative banks at the village level, the central cooperative banks at district level, and the state cooperative banks at state level. If you will see, then you will find these cooperative banks are working in the three level, and it is working in a very good way, and they are also regulated by the Reserve Bank nowadays. On the recommendation of the All India Rural Credit Survey Committee, government converted Imperial Bank into a State Bank of India came into existence in the year 1955 with the passage of the State Bank of India Act 1955. So, the Imperial Bank were formed with the amalgamations of the three presidency bank, but the later on that the recommendations which is made by the All India Rural Credit Survey Committee, the government converted the Imperial Bank to the State Bank, and the State Bank came into existence in the year 1955, and that were constituted under the with the help of the State Bank of India Act 1955. Now, in pursuant to the provisions of the State Bank of India, that is Subsidiary Banks Act of 1959, the following banks were constituted as subsidiaries of the State Bank of India. These are the State Bank of Bikaner, the Bank of Indore, the State Bank of Jaipur, Bank of Mysore, Patiala State Bank, Travancore Bank, Hyderabad State Bank, State Bank of Saurashtra. So, these were at the time, because the State Bank of India was established to work as an agency for the Reserve Bank of India, and alone the State Bank of India cannot do that. So, for the subsidiaries purpose, the other subsidiaries bank were established to help or to work under the guidance of the State Bank of India, and as I have named these banks were the State Bank of Bikaner, Bank of Indore, State Bank of Jaipur, Bank of Mysore, Patiala State Bank, Travancore Bank, Hyderabad State Bank and State Bank of Saurashtra. Now, the very interesting things as far as concerned that on 1st January 1963, the State Bank of Jaipur and State Bank of Bikaner were amalgamated to form the State Bank of Bikaner and Jaipur. Thus, there are 7 subsidiaries of State Bank of India. Now, the major events which took place as far as concerned the development of the banking system in our country, that is the nationalizations of bank. On July 1969, that was a fateful day in the current history of the Indian banking. On that day, the Government of India issued an ordinance for the takeover of 14 major scheduled commercial banks with more than 50 crores of deposits with effect from 19 July 1969, and these banks were the Central Bank of India, the Bank of India Limited, the Punjab National Bank Limited, the Bank of Baroda Limited, the United Commercial Bank Limited, the Canara Bank Limited, the United Bank of India Limited, Dena Bank Limited, Syndicate Bank Limited, the Union Bank of India Limited, the Allahabad Bank Limited, the Indian Bank Limited, the Bank of Maharashtra Limited, and finally, the 14th one is the Indian Overseas Bank Limited. So, these 14 banks who had at the time the 50 crores the capital, and they were nationalized. After the 11 years of nationalizations of 14 commercial banks, the 6 most banks, each with demand and time liabilities exceeding rupees 200 crores, were nationalized in the year 1980 with effect from April 15, 1980 by issue of an ordinance and then enactment of the Banking Companies Acquisition and Transfer of Undertakings Act 1980. These banks were the Andhra Pradesh Bank Limited, the Corporation of Bank Limited, the New Bank of India Limited, the Oriental Bank of Commerce Limited, the Punjab and Sindh Bank Limited, and the Vijaya Bank Limited. Therefore, we can see by nationalizations of these banks, the ownership and control of these new banks vested in the central government. Each bank which was taken over was paid compensation equivalent to the amount mentioned in those acts at that time. Now, the second part which I am coming, and that part is the evolutions of banking laws in India. We will discuss in the very details the latter part of the discussion, but for this period, just I would like to make you the name of this some of the acts that as far as concerned the banking has its own laws, but the other laws is also applicable. So, the laws of contract, the laws of torts and other branches of commercial and civil law are applicable to banks as to others. The Indian banking law is based to a large extent upon the English banking law. During the British rule in India, the English law relating to the negotiable instruments was applied by courts in India when the contesting parties were Europeans, but in the case of Hindus and Mohammedans, their respective laws and usages were made applicable. Where, however, the parties belong to the different communities, the law and uses which governed the defendant were applied at the time. Now, the sum of the laws is I would like to mention here that through which we are regulating the banking systems in our country. The number one, the Negotiable Instruments Act 1881. To regulate the law relating to the bills of exchange, the promissory notes, the checks, the Government of India enacted Act 6 of 1840. Though the Negotiable Instruments Bill was introduced in 1866 to codify the new law regarding the negotiable instruments, it became an act in 1881 with the several changes. So, we got the one act, that is Negotiable Instruments Act 1881. The second important legislation as far as concerned to regulate the banking, that is the Bankers Book Evidence Act 1891. The Bankers Book Evidence Act 1891 is an important legislation which is made for bankers only in India. It is a special given certain privileges to bankers as regards the mode of providing of entries in their books and the productions of thereof in the courts of law. The third very important legislation as far as concerned to regulate, that is the Reserve Bank of India Act 1934. As we know that the Reserve Bank of India Act 1934 was enacted for the establishment of central bank of the country, and the Reserve Bank of India was established by the help of that act. The main purpose of the act is to empower the Reserve Bank of India to take over the issue of banknotes and currency from the central government and maintain the monetary stability of the country. The very important legislations as far as concerned the banking law is relating to the banking law, that is the Banking Regulations Act 1949. Previously, the Banking Companies Act, it was known as the Banking Companies Act 1949. The law relating to banking we find in India today is the outcome of the gradual process of evolution before 1949. The Indian Companies Act 1913 contained special provisions relating to banking companies were felt inadequate and were subsequently incorporated in the comprehensive legislation passed in 1949 under the name of Banking Companies Act 1949. It was passed to consolidate and amend the law relating to the banking and to provide for the nature of transactions which can be carried on by banks in India. It came into force with effect from the 16th March 1949, and its name has been changed in the Banking Regulations Act 1949 from 1st March 1966. In that way, we find that the one of the single legislations which we can say which empowers the Reserve Bank, because under the Reserve Bank of India, the Reserve Bank has very limited power as far as concerned that the powers regulate the its own affairs and to issue a banknotes, but the how to regulate the other banks, that were the powers were conferred with the help of the Banking Regulations Act 1949, as we will discuss the Banking Regulations Act separately the later on. Then if we will see the Deposit Insurance Act 1961. The Deposit Insurance Corporation Act 1961 is intended to provide for the establishment of a corporation for the purpose of insurance of deposits and guaranteeing of credit facilities and for other matters connected therewith or incidental thereto. The central government shall establish a corporation with its head office at Bombay. The authorized capital of the corporation shall be 1 crore of rupees, but the central government may increase such capital from time to time not exceeding 50 crores of rupees. Now, this Deposit Insurance Act plays a very vital role, and you might have read in the newspaper that as far as concerned that the customer status as a creditor, it is unsecured creditor, but when we are talking about where your money is safe, then answer is still your money is not safe, but we can rely on the, because the Reserve Bank is regulating the banking activities. So, the Deposit Insurance Act 1961 helps to secure some money, and at present your 5 lakhs rupee is secured through the Deposit Insurance Act 1961. Then another, we have a very important legislation, that Foreign Exchange Management Act 1999. Before coming into existence of this act, we had the Foreign Exchange Regulations Act 1973, but that was replaced with the help of the Foreign Exchange Management Act 1999. This act is mainly to regulate the foreign exchange and establishment of enforcement directorate. The Government of India enacted the Foreign Exchange Management Act 1999. The very important legislations as far as concerned that today we are living in a you can say the technological era, and particularly the digitized or the digital era we can say, and the banking is also not away from it. The banking adopted the e-banking system, and to regulate that activities we enacted another act as far as concerned the Information of Technology Act 2000. The Information of Technology Act 2000 was enacted to provide legal recognitions for transactions carried out by means of electronic data, interchange and other means of electronic communications, mainly referred to as electronic commerce. It came into force on 17th October 2000. So, in that we have experienced that in the modern times the banking sector, they are working through the means of electronic, they are applying all sorts of transactions with the help of electronic means. As far as concerned, we can see that there is no need to go the bank. You can regulate your all the banking activities through your smartphone, and it is possible, but at the same time there are the risks or how that the e-transactions can be regulated. For that purpose, we required a very important legislations, although we will discuss in a separate chapter the merits, demerits of the e-banking. But as far as concerned that there is only the single act which will have through we can regulate the electronic transactions or e-banking, that is the Information Technology Act 2000. But before I conclude, I would like to mention here that from that the 2000 BC, we started our banking journey, and we reached to the as far as concerned that the banking practice. Without agitations, I would like to mention here that the Britishers, they have contributed lots for the establishment of banking system. But in the other hand, we can also understand that due to the Swadeshi movement, the Indians, they themselves given the more emphasis to promote or to develop the banking business in our country. But at present time, which will have that the legislations which are very important, that the three very important or in the better way we can say the four very important legislations are. The one, that is the Banking Regulations Act. As we have seen that we have the specific legislation that is the Reserve Bank of India Act 1934. Under that act, the Reserve Bank of India was established, and the management of the affairs of the Reserve Bank were given, and the main affairs of the management of the Reserve Bank of India is to maintain the monetary stability of the country. So, for that purpose, that the issuing of notes and the other things, how to regulate that, these were mainly mentioned, and the business, what kind of the business can be transacted by the Reserve Bank of India and how it can be regulated, that is mentioned under the Reserve Bank of India. But as my concern, how to regulate the Commercial Bank of India, that powers were not conferred under the Reserve Bank of India Act. So, for that purpose, that we required the new kind of the legislation. So, that might be the reason in the year 1949 the new act were enacted, as the presently we are calling it the Banking Regulations Act. The Banking Regulations Act mainly the mean to empower the Reserve Bank of India by giving all sorts of the power, functions to regulate the commercial banks which are existed today. Not only that, the Banking Regulations Act also empowers the Reserve Bank of India to regulate the cooperative bank and to regulate the financial institutions. At the same time, that the to regulate the monetary stability of the country, the foreign exchange is one of the very important part, and for that purpose that we have the specific legislation that is the Foreign Exchange Management Act 1999. And then we find the another very important legislations which we will discuss in a very details, that is the Negotiable Instruments Act. The Negotiable Instruments Act, which defines what do you mean by the negotiable instruments, and under section 13 of the negotiable instruments, the three important aspect has been dealt, that is the promissory note, the bill of exchange and the check. And as we know, the check plays a very significant role. So, this act which will deal about that, what are the powers, what are the rights of the makers of the promissory note, the makers of the you can say the bill of exchange, or the makers of the check. These things were discussed in detail under the Negotiable Instruments Act. So, we will discuss all the things again in the another chapter, in the another lecture, in the details as far as our requirement under the laws, banking laws or negotiable instruments. With these, I would like to thank you all. Thank you very much.